Okay, so our last topic is fiscal policy, and as I promised, I will record the lecture and upload it. So I'm recording here from Oxford. So let's start. Fiscal policy is our next topic, and it's a macroeconomics course in which we discuss a lot of different things. And the last thing what we want to discuss is a policy. Before that, we discussed monetary policy. Now we want to discuss fiscal policy, and this is the policy designed by the government of the country, like whatever who is in power. So they decide about their fiscal policy. Now, what is the main contents or main headlights of this chapter is what fiscal policy is. That's what we define it. We want to define the fiscal policy and why it is an important tool in managing economic fluctuations. So is there any we discuss the business cycle, and if the economies are in recession or in economies are at boom, how we can deal with that fluctuations with the help of this policy tool. So we normally two policy tools we discuss in macroeconomics. One is a fiscal policy and the other one is a monetary policy. So this is the one of the policy tool available to the government to manage the economic fluctuation. Which policy constitute an expansionary? Now, when we discuss what is fiscal policy, then after that we will talk about that there are two approaches. One is what we call it as a expansionary fiscal policy, and the other one is a contractionary fiscal policy. So these are two opposite, like we can understand from these words as well, like expansionary, in which the government wants to expand the economy, and when we are saying contractionary, in which the government wants to contract the economy with the help of this fiscal policy tool. So fiscal policy has a multiplier effect, and how this effect is influenced by automatic stabilizer. Because we know when we give some money to anyone to spend, so he's going to spend it. Now this spending is not going to be stopped there. So the one when he spends, it generates the other's income. The other is also going to spend, and by this way everyone is spending depending upon their marginal propensity to consume. And we're going to discuss that idea as well, what is marginal propensity to consume. Now, why government calculate the cyclical adjusted budget balances? So we will talk about that as well. Why a large public debt may be a cause of concern, and why implicit liabilities of the government are also cause for concern. So let's start. Government spending and tax revenue for some high income countries in 2007. So you can see here most of these developed countries, but these developed countries are facing the problem that their spending is greater than what the revenue they are generating through tax. So 37% is the government spending, 34% is the tax revenue. So whenever there is a difference of a revenue or the expenditure, so there are two solutions. Either we have to borrow it, or what we do, we can print money, or but printing money is a monetary policy instrument. So mostly the government is focusing on buying or borrowing money. So they cover this deficit through borrowing. So we can see here same is the case with Japan. Although Canada is lucky, but that's only for 2007, not now. Now they are in deficit, that they have some positives saving. France, again, you see 52%, 50%, 51%, 55%. So that's the way that it's a percentage of a GDP. It's not like a 50, how much is the. So we see here, we already know that is the aggregate output or GDP, which is composed of consumption expenditure, investment expenditure, government spending, and net exports. Now the fiscal policy is managed from this as well as to influence these factors. So one thing is that they can increase or decrease the government spending. That's a direct effect. Indirectly they can influence the consumption expenditure, investment expenditure, or by net exports, change in net exports. But this is indirect influence, not the direct. Direct one is that they can increase or decrease the government spending. So fiscal policy is the use of taxes, government transfers, or government purchases of goods and services to shift the aggregate demand curve. How we want to shift the aggregate demand curve. How we can do it? Either through taxes, through government transfers, or see. Now, what is the impact of tax or a government transfer? If we increase the government transfer, the consumption is going to increase because the household will get more money from the government. And how we can influence the investment spending or the consumption spending by reducing the taxes. So if we reduce the tax, the take-home income of the individuals or the household increase, and that is going to be influence or increase the consumption and investment. And same is the case if the tax is reduced, so the exporter is going to be able to charge less price from the international market, and by this way the exports can also be increased. So these are the indirect ways through which the government can influence, but the government purchases the direct impact of G. Now what is going to happen, like if initially the equilibrium is here and we want to move it to the long run equilibrium, you see this is very standard model, ADAS model. Because of any reason, if the economy is at this position, so what gap we are facing? Recessionary gap we are facing, because it's below the potential level. Now this recessionary gap can be tackled by shifting the AD curve back to the situation where this long run equilibrium is achieved. How we can shift the aggregate demand? Aggregate demand, we want to shift it to the right. Now right means that we want to increase the aggregate demand. So as we just discussed, three things are available, or three options are available for the government. One is they increase the government spending, G, and G is a part of AD, so that can shift. The other option is that they reduce the taxes, so by this way consumption, investment, net exports will increase, and by this way they are able to shift the AD curve. And the third option is that they can increase the transfer payments, and by this way consumption increase and shift. So it's not necessarily that the government take only one option. They can exercise simultaneously two or three, all the three options together to impact. If the economy is of this situation, like they are of an inflationary gap, like here, and they want to move it, this aggregate demand curve, to the left, or they want to reduce the aggregate demand curve to eliminate this, or to deal with this inflationary gap, how they can do it? By increasing the taxes. So what is going to happen when they increase the taxes? Consumption will go down, investment will go down, net exports will go down, and by this way AD curve shift to the left. Or they can reduce their transfer payments, consumption will go down, or they can reduce their spending, and by this way the AD can move to the left to reduce this inflationary gap. So we can see that there is these solutions are available. But the problem is that if these solutions are so simple, like we at an undergraduate level we are discussing it, so why not the government do these things at their level quickly and solve these imbalances, or there's gaps in the economy. The problem is that whenever the policy is implemented, there is a time lag. In the case of a fiscal policy, there is an important reason for caution. There are significant time lag. Now time lag means that when we identify the problem and when we start to implement the policy to solve that problem, quite long time is required for that. Why? Because what they have to do, first of all, they have to identify how much is the gap, what gap it is, how much is the gap. So first of all they identify. It takes time because they have to collect the data, and then they have to analyze that data, and with this analysis they can be able to make. Then government has to develop a plan for dealing with that problem. Now this plan takes time to design, and then there is a process of approval of that plan. Like normally in a democratic countries like Canada, we have to go to the parliament to pass the plan, And then after, and you know, when you have to go to the legislation process, it takes time. And then after that, they have to start executing it. And execution is not like a button which we can on or off. It takes time. It's not possible that if they decided, okay, we want to spend $5 billion, so in a day they cannot spend it. So it takes time to 1, 2, 3 years to spend that $5 billion. So it means that there's a significant time lag in the implementation of the fiscal policy. And for that reason, as I already mentioned you, that the economies are dynamic, they are not static. So if there is a problem and the government identifies that there is a gap of a recessionary gap of $100 billion, so they start planning. Then they pass the they went through the process of passing that plan from the legislators, and then after that, when they start executing, it takes 1 or 2 years to execute it. Now this whole time the economy is changing, it's not going to be stay at the same time. So maybe the gap is going to be reduced to 50. Now the government is spending 100 billion, then the plan is reduced, the gap is reduced to 50. So what is going to happen? It's overshoot, right? Or same is the case with the undershoot as well. So there is always this type of problem. Fiscal has a multiplier effect. Now fiscal policy has a multiplier effect, because when the government spends $1, this $1 is going to be multiplied. Why it's going to be multiplied? Because that creates an income for the first person who is going to spend it, and creates an income for the second person, and the second person is also going to spend it, so it's going to generate income for the third person, and by this way it's multiplying. The only fraction that is going to be eliminated from this process of multiplying is that how much each one is saving. Like if we give them a $1, how much they save and how much they consume. So if they spend 70 cents and save the 30 cents, so this 70 cents is become the income for other. Now who also saves 30% of it, so you're going to save $2.10 and spend the remaining, and that is the income for the third person. So by this way, it is not, it's going to be multiplied forever, it's not an infinite, but it's going to be reduced by the fraction of the saving. And this is what we call it as a marginal propensity to consume and marginal propensity to save. So fiscal policy leads to an increase in real GDP, larger than initial rise in aggregate spending caused by the policy. So conversely, contractionary fiscal policy leads to a fall in the real GDP larger than initial reduction. This is what I said, that overshooting or undershooting because of the time lags. The size of the shift of aggregate demand depends on the type of fiscal policy, and that's what I was trying to say. The multiplier on change in government purchase is, if the government purchase change, like governments say that okay, we only spend more or we only reduce our consumption, then we see that what is going to happen on the economy. Then the multiplier effect is 1 over 1 minus MPC. And if they adopt a policy of a tax reduction or transfer payments, then the multiplier effect is, or multiplier is MPC over 1 minus MPC, because part of any change in tax or transfer is absorbed by saving. Now this, what is this MPC? And I just mentioned MPC is a marginal propensity to consume. Now if you get $1 income, like whatever income is, you get $1 extra. Now how much you spend out of this $1, like a 70 cents, 80 cents, and you save to 20 cents, 10 cents, maybe 50 cents, whatever. So that ratio which you are consuming is called marginal propensity to consume. For additional income, how much you save, how much you consume. Now how much consume is the marginal propensity to consume, and how much you save is a marginal propensity to save. The total is 1, and we divide this 1 among the marginal propensity to consume and marginal propensity to save. Now this marginal propensity to consume and marginal propensity to consume is going to give us a multiplier, that how much going to if government increase 1 billion, how much is the total increase in the purchases or the output. So the government hands out 50 billion in the form of a government transfer. So for example, if the government gives out, we are first focusing on government is increasing their spending. Transfers. So government is directly giving, and the transfer payments multiplier is this. And the second one, MPC over 1 minus MPC. So there is no direct effect on aggregate demand by government purchase of goods and services. So the GDP goes up only because household spends some of the 50 billion. So how we can calculate the MPC into 50? For example, if MPC is 0.5, the first round increase in consumer spending will be 25 billion. The initial rise in consumer spending will lead to a series of subsequent rounds. That's what I mentioned. So here we see that what is the impact. So if the government rise in the purchase of goods and services, like G factor, like G, if they increase the G by 50 billion, then the formula is 1 over 1 minus MPC into 50 billion. So it's going to be 2. So the overall 2 means 100 because 50 into 2. You see here 100. And if they use the government transfers or reduction in tax by 50, so what is going to happen? The formula is MPC 0.5 over 1 minus 0.5. So the multiplier is 1. So here the multiplier is 2, here the multiplier is 1. So 50 billion increase the overall spending in the economy by 50. So taxes, use governing taxes and some transfers as an automatic stabilizer, reducing the size of the multiplier and automatically reducing the size of fluctuation in the business side. In contrast, discretionary fiscal policy arises from a deliberate actions by policymakers rather than from the business cycle. The budget balance. Now, whenever we talk about the fiscal policy, budget is the way that how the government announce their fiscal policy, and every government every year announce their budgets. So we see here how do surpluses and deficits fit into the analysis of fiscal policy. Are deficits ever a good thing or a surplus a bad thing? No, that's not. It depends upon the economic situation. So this way we can say that it is the equation that explains our overall discretionary expansion fiscal policies. We can say here, this is our public spending and how we can spend: collect taxes minus transfer payments and minus G. So this is going to be the balance budget, public spending, or so increased government purchases of goods and services, higher government transfers, or lower taxes reduce the budget balance for the year. Now, if we adopt expansionary fiscal policy, the budget surplus smaller or a budget deficit bigger, because if you're spending more, so what is going to happen? Either you save less or you're going to be in negative, you borrow. If you are spending less, you are saving more. So what is going to happen? Smaller government purchases of goods and smaller government transfers or higher taxes increase the budget balance, making a budget surplus bigger or deficit smaller. Some of the functions in the budget balances are due to the effects of a business cycle. To separate the effects of a business cycle from the effects of a discretionary fiscal policy, government estimate the cyclical budget balance. So that's the reason that government make cyclical budget balance. So most economists do not believe the government should force to run a balanced budget every year, because this would undermine the role of a taxes and transfers as a automatic stabilizer. So it is not necessary that the government should run every time a balanced budget. When we are saying balanced budget, it means whatever the income the government has, they spend it all. Neither borrow nor save. That is the situation. No. So a policymaker concerned about excessive deficit sometimes feel that rigid rules prohibit, or at least so government don't want that the policies should be automatic, like if the budget deficit reach to that level, the taxes increase, or if if we include these things automatic, then there is no need of a government. Government needs a discretionary power that they want to decide and decide according to their own interests. So in the world there are two types of policy adoption. One is an automatic stabilizers, and many advanced countries, especially the Scandinavian countries, they are adopting these policies. So the government roles are reduced in case of a fiscal policy, but at the same time that promotes the transparency and all these things in the economy. Your policymaker concerned about excessive deficits. Excessive deficits means that the government is borrowing too much, but the government ultimately has to pay, and how they can pay? By increasing the taxes. So when the government is borrowing too much, that's a worrisome for the public, because in the future they have to pay more taxes. So Europe search for a fiscal rule. Now you know that in Europe there is a monetary union. So monetary union means that their monetary policy is same, designed by the European Central Bank, ECB, but fiscal policy is independent, because they are all sovereign nations, and every sovereign nation has its own government, and every government is deciding according to their own political agenda. So by this way, they are not under the fiscal rule, but they are under the monetary rule. And that's the problem. All the time they are facing crisis. Like some governments are spending, they promise that they will spend less, but they spend more. They promise that they will do this, but they don't do that. So that's the problem always we see. In 1999, a group of European nations adopted a common currency, the euro, to replace their national currencies. The government of member countries signed to the European Stability Pact. The agreement requires each government to keep its budget deficits. So that's the agreement they signed after the certain crisis, that they keep the budget deficit 3%. They're not going to spend more than 3% deficit. So that's the stability pact. But still, there are some issues. Stability pact, however, limit a country's ability to use fiscal policy. So in 2011, the European tried again, this time against the background of a severe debt crisis of Greece, Ireland, Portugal, Spain, and Italy. All lost their confidence of investors. An effort to these nations to reduce their deficit seems like to push Europe back into a recession. So the agreement reached in December 2011 was framed in the term of a structural budget balance, more or less corresponding to the cyclical adjusted budget balances. So according to the new rule, the structural budget balance of each country should be very nearly zero, with the deficit not to exceed 0.5% of GDP. This seemed like a much better rule than the old Stability Pact. Yet big problems remained. One was the question of how reliable structural budget balance should be estimated. Also, the new rules seem to ban any use of a discretionary fiscal policy under any circumstances. So now persistent budget deficits have a long-run consequences. If the government is every year is running a deficit budget, so what is going to happen? The debt is accumulated. So you have to keep it in mind, the difference between debt and deficit. Deficit is a 1 year excess of expenditure over the income, but debt is when you want to cover this, you borrow money, and that is called as a debt, and that is accumulating over the years, like every year. And same is the case with the individual as well. Like if your incomes are less and your expenditures are more, so what do? You borrow, and you borrow all the time. If you borrow all the time, your debt is going to increase, multiplier, or going to be getting bigger and bigger. The same is the case with this public debt as well. Like most governments borrow, and then they borrow, their debt is going to be increased. So in 2009, the government of Greece ran into a financial wall when most investors lost confidence on Greece's financial future and no longer willing to lend to the Greece government. And by this way, they're interested, because you know, when a borrower is weak, or when the borrower is not having a good financial standing, then what they're going to do? The bank charge high rates. Same is the case with the Greece. Is then when the Greece went to borrow money, the banks or these debt clubs, or these where you can get debt for the countries, it's going to charge 10 times more than Germany, because Germany was a stable economy, so they have to charge. So the Greece and the interest rate on a 10-year bond issued by the German governments is around 3 to 2%, but when the Greece want to sell it, it's going to reach to 16 or 17%. Now, we have to, as I mentioned, we have to keep it in mind the difference. The deficit is the difference between the amount of money a government spends and the amount it receives in taxes over a given period, like a 1 year. While the Canadian budget deficit is the fiscal year of this was that much billion. On the other hand, debt is the sum of money a government owes at a particular point in time. So that's a liability. The Canadian federal debt was around 582 billion. You see, it's a 1 year deficit is just a 26.2 billion, but the accumulated debt is 582.2 billion. This is a huge debt. Deficit and debts are linked because government borrows when government runs deficit, but they are not the same thing, so they can even tell different stories. Italy found itself in debt trouble in 2011 and had a fairly small deficit by historical standards, but it had a very high debt, a legacy of a past policies. Now, what is the impact of a government debt when the government borrow too much money? That's crowd out. Now, crowd out is a concept we say when the government borrow too much money from the economy or from the banks, so the less money is available for the private sector to borrow for productive activities. So, and in extreme cases, that may lead to a government default, resulting in economic and financial turmoils. Can government that has a trouble borrowing just print money to pay off its bill? Normally, that's not the case. That they can, if they print the money, that is going to create another problem, and that problem is inflation. So it can, but it leads to another problem. So you see here, this is a very good chart to explain. Most of the countries are in debt. Net public debt as a percentage of GDP, including Canada, Germany, Spain, UK, France, United States, Belgium, Ireland, Portugal, Italy, Japan, and Greece. All these countries so have a huge debt. Like Greece is 164% of their GDP. But only one country, which is Norway, and all other Scandinavian countries are also, but here the Norway is mentioned more profoundly. That 160 billion assets, not the debt. So this they are rich governments in the sense that they have assets instead of all these governments or countries which have a debt. So widely used measure of fiscal health is a debt to GDP ratio. That's we always measure for the good economy or a bad economy. Debt to GDP ratio. It should be low. If it is high, then it is considered to be the so the number can remain stable or fall even in the face of a moderate budget deficit if GDP rises over time. So just before the 2008 and 9 recession, the combined amount of government debt in Canada was 23,000 per capita, in which 2/3 of the debt came from the federal government and 1/3 from the debt issued by the lower level government. So 23,000 every one of us. So this is much is the debt. Other than the debt, the government also have some implicit liabilities which is not appearing in the books, but still there are liabilities like pensions or other commitments or spending promises made by the government that are effectively a debt despite the fact that they are not included in the usual debt statistics. Now, the solution which people recommend that, okay, if the governments are running a deficit, why not they cut down their expenditure and make it less or reduce the deficit or maybe make it surplus. But the problem is that austerity is a word we use that when government cut down their expenditures or you start using your resources more rationally to cut down everything or cut down not more productive activities and all these things. But the problem with the austerity is that it is very dangerous for the economy as well. Like if the government starts austerity and the business also starts austerity, what they do? They will buy less things. So when they will buy less things, what is going to happen? The economy goes into recession. Demand goes down, and by this way there is a problem. So the unusual answer is fiscal austerity. The government is in question, cut spending and raise taxes. both to reduce its need for borrowed funds and to demonstrate to the potential lender that it has the ability and determination to do what's necessary to honor its debt. But the problem, and that's why we are calling it as a dilemma, is that austerity means implementing a contractionary fiscal policy. So when we contract, the economy is going to contract, and that's create another problem, which is more painful for the economy. So that's exactly what happened to Argentina in roughly 4 years preceding its debt default. So late in 2001, facing popular protests, the Argentina government collapsed and the country defaulted on its debt. And since 2009, Ireland has gone through a similar experience, although the origin of its trouble were different from the Argentina. Until the 2008 crisis hit, Ireland government generally ran a more or less balanced budget, and it had a relatively low level of debt. So that's the difference between Argentina's dilemma and the Ireland dilemma. So you see, these are the information regarding the European economies. So by this way, we covered the topic which I want to discuss with you: fiscal policy. This week there is no learning activity. You have to final your project and submit it. So yes, go over this video and try to understand. And because the final exam also have some questions from this chapter, but make sure that all the questions are from the chapters what we discussed after the midterm. So that's a good news. You have to only focus on those chapters. So thank you very much for your cooperation so that I can participate here in Oxford. So let's see you next week in class. Bye bye.